All right, we are live. Hello and good morning, everyone, to our Saturday edition of Stock Market After Hours. It's great to be with you on a Saturday morning. Like to mix these up every once in a while just to be able to include other audience members in case the other timing isn't great for them. So let's do some Saturdays every once in a while. It's been a request that I've gotten over the years. So here we are mixing in another. I know we've done it in the past. So it's been a while. So hope you guys are doing well. Let me know, where are you tuning in from, because we should get a nice broad audience here. And what have you been buying in the past week? We've saw a little bit more of a volatile market overall. So some buying opportunities are starting to creep into the market. So first off, let me know where you're tuning in from and what have you been buying in the stock market. So Ketlin, tuning in from Belgium. It was probably about a year, not a year ago, a decade ago, I was going to say, that I last went to Belgium. One of my favorite countries to go visit there. Obviously, I love beer and chocolate, and they got the best of both of them right there. So I loved going my time in Belgium. Good morning, David. Drew is checking in from Minnesota. Great to have you, Drew. Sean in the house. Singapore, watching this live stream at 11 p.m. in Singapore. There we go. Bought some SCHD, VTI, and QQQM this week. So nice little mix there. Carl, good to see you, my friend. Kevin's tuning in from Illinois. Terry, DMV. John Bircher making the Saturday edition. Tuning in from Oklahoma. SCHG, one of my favorite growth ones there. QQQM, another growth one, and some options. Turning in some more options for some more income there. Halito, how are you doing? Tuning in from the home of the comeback king. Good to see you, Robert. Good morning from Honduras. Nice. Skippy, where we tuning in from, Skippy? New York, Western New York. Bought some Coca-Cola. Coca-Cola is looking pretty intriguing there. So it's kind of at a I call it a breaking point, because from a technical perspective, you got some moving averages that are crossing over in a not so great way. But on the flip side, it is up against a key support level. So if it can hold that, I think we could see Coca-Cola bounce back a little bit. But if it cannot, there's going to be more trouble ahead there from that standpoint. Jeffrey, up early on the West Coast, tuning in from Washington. Nice, Jeffrey. Good to see you, my friend. Howdy from Scottsdale Valley, upstate New York with Seth. Good morning, just for Lucky. Seamus from Vancouver, British Columbia, tuning in as well. Awesome. Well, great to have you guys on this Saturday morning. For some of you, it's Saturday evening. In the case of Sean, it's 11 p.m. So John from Deer Woods, awesome. Well, great to have all of you guys here today, and we'll have more that'll be tuning in. So again, Stock Market After Hours, Saturday edition. Let's look at our economic update here. So there's our slide. Market performance. The Dow Jones up 15% year to date. However, as you can see on our screen here, a lot of red for the last 5 days, down 2.2% for the Dow Jones. S&P 500 up 23%. However, over the past 5 days, down roughly 2.5%. And the NASDAQ of the big three was down the most, down 3.3% over the past 5 trading days, but still up a solid 24.4% this year. The Russell, the small cap index, is up nearly 14% on the year. However, it has gotten hit the hardest of all of those indices right there, down 5.5%. Oil has struggled, down roughly 4.5% the last 5 days. But one thing that is not struggling has been Bitcoin. And Bitcoin is up over $90,000 now, up 12% in the past 5 days. So Bitcoin's moving there, folks. Something to keep an eye on. In terms of valuation, even with the sell-off, we were up over 22 times in the S&P 500. That has come down to 21.7. Still in this slightly overvalued, overstretched condition that we're in, compared to a 10-year average of roughly 18.1. Estimates haven't really changed all that much. So the forward 2025 EPS estimates for the S&P 500 has been sitting kind of right around 270, 269, 270. In terms of the average for analysts. So that's where we get our 21.7 times. In terms of interest rates, 10-year, it kind of did some seesawing, but last week when we had this power hour on the normal time, up to Saturday morning where we're at here today, 10-year sitting at 4.4. The 2-year, though, did have some movement and did tick higher a little bit. So it went from 4.28 up to 4.33. So that's where we're at in terms of our economic update. Fear and greed index, we were in a firmly greed standpoint, but with that sell-off, that kind of rebalancing that we got at the end of the week there, we're sitting almost dead center in neutral. Let's go over and head over to our sector performance now to take a look at which sectors have been performing the best here. So let's start by taking a peek at year to date. We'll zoom in here so we can actually see our numbers that we're even talking about. So as we can see, the financial sector now is leading the way. So some interesting shifting here. Again, they're all very close right now, but the financial sector up 32.3%. That's been a big winner since the election there. So 32.3%. We got communication services up 32.09. So pretty much right on their tail. And then information tech also on their tail at 31.8%. Utilities still holding down up there, up 24.7%. So those are the four sectors right now on a year-to-date standpoint that are actually in the green and above the overall index. So again, all 11 sectors are still in the green. We have a couple down here that are holding on for dear life. We have healthcare up 3.8%, materials up 6%, and real estate up 7% in terms of year-to-date here. So let's see what's been working over the past few months. Consumer discretionary has been the best, up 21%, easily beating the next closest, which is financials up 15.8%. Industrials up 10.6%, and communication up nearly 10% themselves. Again, the worst performer over that 3-month stretch, and again, it's really been over the past 2 weeks, has been healthcare, down 6.6%. Let me show you what I'm talking about here. Going at the month over month here, you could see healthcare down here over the past 30 days down 8%, easily the worst performer. Materials down 5.7%, consumer staples down 2%. What's been the best areas? Well, it has been consumer discretionary up 9%, financials up 6.5%. Those have been the two areas to kind of focus on. And a lot of that consumer discretionary is baked into what Tesla and Amazon have done over the past week and a half here. Financials have been, that one's a little bit more broad in terms of since the election, they have kind of moved up together. But consumer discretionary has largely been that 40% move in the likes of Tesla. We have seen Amazon get through that Bezos wall of 200, and he even sold again at that 200 level, and shareholders pushed it through. So that was a very good sign, especially from a technical perspective. Communication services up 2.7%, and the energy sector up 1.2%. So year to date, 3 months, 1 month, all of them sitting right there at 4 sectors that are above the overall index there. So again, we continue to see this broadening out in terms of different sectors. 2023 was all about technology. It was all about communication services. And I talked about it coming into 2024. What do we want to see working? We want to see more things working, really. And we want to see that broadening out in the overall market. That is the sign of a healthy move higher. If you continue to have only 1 or 2 sectors that are so large and they're just pulling the entire S&P 500, it can mask a lot of underperformance. And in 2023, although it was a fantastic year for the index, if you actually looked more at things like what we looked at on this channel, the equal weighted S&P 500, and you looked at the other 490 stocks, you had a ton of companies that weren't just underperforming, they just flat out weren't doing well at all. But it was all masked because those Mag 7 companies are so large and they had such amazing years that they were able to just lift the entire S&P 500. So we want to make sure that we continue to see broadening. We want to make sure that we look at the sum of the parts and not just look at the headline numbers. You don't want to look at just the Dow Jones. You don't want to look at just the S&P 500. You want to see what's working under it. And that's why we like to look at all of these different sectors. At least, we're not looking at individual companies right here, but we're looking at all 11 sectors within the S&P 500 there. So definitely something to consider when doing your due diligence to find stocks to buy. And speaking of stocks to buy, we have our Investing Accelerator, our group coaching program. And again, this is I mentioned it in our post-election webinar, if you were able to join us there. This is our last available session before the end of the year and before prices go up. So if you've been on the sideline about really understanding and learning how to pick stocks, how to analyze companies, and most importantly, how to value companies, then definitely sign up for the Investing Accelerator group coaching program. This is something that you can take on your own time. All of the replays will be scheduled and posted within our school community. So if you're unable to join us live every Tuesday at 8 p.m. Eastern time, there's not a problem there. It's usually 50-50 in terms of folks that can join us live and folks that watch on their own pace. So we have an entire school community where you're able to ask questions. You have access directly to me for email. You get all the handouts, any of the valuation tools that we have, and dividend calculators and things like that. Whether you are brand new to investing or whether you've been investing for a number of years, this is the program that's going to help you take your investing to the next level there. So I will be posting a link to be able to sign up to that here in the comment section, as well as in the description down below. But we do have 4 spots left that we've opened up at a discounted rate. So if you are on the sideline there about jumping into that, definitely make sure that you sign up sooner rather than later, because those are going to be gone, and we will be starting on Tuesday next week. So let me go ahead and post that in the comment section right now for you, and then I will also be posting it down in the description as well. So here is the sign up where you can go and claim one of those final 4 spots, get some more information there. So let's keep rolling ahead on our Saturday edition here. And what did we get this week? We got some economic news. So we got a CPI report. CPI came in month over month, up 0.2%. That was in line with expectations. Core CPI, which I believe is more important. You want to look at the core piece. It takes out things like energy and food costs and things like that are a lot more volatile and looks more from a holistic approach without those volatile things. That was up 0.3%, again, in line with expectations from economists. CPI year over year was still up 2.6%, again, in line with expectations. And core CPI came in at 3.3%, also in line. So all 4 reports came in line there. And what is this showing us? This is showing us that inflation continues to be sticky. Inflation did have a nice move down where it appeared like we're getting it under control, but now we're starting to see creep back up. And those are some concerns about some of the policies that might be going into place here around tariffs, around tax cuts, and some deregulation things. So we have to be mindful of that. Is we don't want to see rates continue to come down, policies that could push inflation a little bit higher here, because it could get us in trouble. I don't think it's going to get us anywhere close to the trouble we were in when inflation was up near 10% by any means, but something to definitely keep an eye on. And that's what the bond market has been showing us there. The more important PPI report, which is more closely watched by the Federal Reserve there, month over month came in at 0.2%. Core PPI month over month came in at 0.3%, which was actually above economists' expectations. Year over year came in at 2.4. Again, that was above. And core PPI year over year came in at 3.1. Again, also above there. So every metric pretty much that you look at here, regardless of timing, was higher than the month prior. Was higher than the month prior, was higher than the year prior as well here. So definitely something that not only does inflation continue to be sticky, we're back to rising now for a couple straight months. And it's something that we want to keep a close eye on, because what are we doing here? We already know that the Federal Reserve is bringing down rates. There's a high likelihood that the December meeting that's coming up, there's going to be another 25 basis points. And I've talked about it on this show already a number of times. And I don't want to, beat a dead horse here, but I believe that the Federal Reserve made a mistake in going too hard too early. In the September meeting, we talked a lot about that was going to be the first interest rate cut. But why do we go 50 basis points? We are always slow to act as the Federal Reserve. So if we're slow to act, why are we quick to get away? Because if you go away too soon and you take your foot off the pedal when things aren't in fact under control, then you run the risk of seeing inflation start to creep up. And what have we seen now for 2 straight months is you are starting to not only see sticky inflation, but rising inflation. They're trying to get this core PPI number back down to 2%. We are now back above 3. We were under 3. Then we crept up to 3. Now we're at 3.1. It's going in the wrong direction. Now it's not out of hand by any means. So this isn't like a major red flag. I just thought it was too early of a move. And I believe we're going to see an extended pause once we go into the new year. December is largely baked in, but I think the January, February, moving forward there, I think we're going to see kind of rates sticking to where they're at, not coming down as fast as a lot of investors and analysts alike were hoping for in 2025 there. So very interesting to take a peek at. Let me jump over here to the comment section and see what is going on here? Robert says, nice, defense stocks are dipping just as I predicted it would months ago. Nice. What do we got? Jeffrey bought some SMH, some U, and some Uber. You bought stock on me, dude? Thanks. Seamus, Palantir. Man, that's a stock that just continues to soar there, and some SPLG. John Bircher, does the inflation stickiness give you some concern for REITs and small caps in the short term? That is a fantastic question there, John. So we've seen the REIT move already. We've seen big REIT moves since we've started talking on this channel over the summer. And those July months is really when we start. That was kind of the takeoff moment for REITs. So when you look across the board, a number of REITs, so a lot of them are still undervalued, but they're not as big of a deal as they were after these 20% moves that we've seen. You know, when I go through, and in that investing accelerator course, as you know, John, you've been through it. When we go through the REIT section there, and we're analyzing REITs, and I ask students that are working with me, because I let them choose, hey, give me some REITs, and we'll go through and show you how to analyze these here. The ones that we're looking at, maybe they're, you know, the upside is 10% and high single digit percent. So it's not something that is as big of a deal as it once was. So I'm kind of pausing on my REITs. There's other things that come into play here is yes, higher interest rates for longer isn't that longer tailwind that we expected for REITs going in. And that's why I believe that we have seen the run up in REITs, and now they're just kind of trading sideways. Some of them have given up some of those gains there because higher interest rates. This is a very high interest rate sensitive. So yes, in the short term, I don't think there's really anywhere for them to go if the rates stay at this higher level for a prolonged period of time. But eventually those are going to come down, which will be that continued tailwind for the sector moving forward. So great question there, John. What else we got here, guys? I bought some more. I still need 15 to hit my next milestone. McVeigh, what is that milestone? Got some more Avi as well. Hisham's bought some Microsoft. The Polish silver stacker. Mark regards from Poland. Awesome. Bought some Uber and ASML. ASML's been a nice little discount there. I'm buying MSTY, incredible monthly dividends tied to MSTR. All right. Did you hear the other day that MicroStrategy is interested in paying dividends? They're going to start paying some Bitcoin dividends per se. So it was an idea that was tossed around on Twitter there, which was very interesting. Mid-State Wrestling. Where do you see SoFi end of 2026? I think that the financial sector is going to have a solid year, because when you think about it, even though rates come down, there's some that have concerns about the net interest margin coming down, which is the difference between what they can earn on interest from loans and subtracting out what they pay for interest on, you know, like if we have money in a savings account, a high yield, a CD, whatever the case may be. So the difference between what they earn on loans and what they pay out on interest is going to be what's called net interest margin. So obviously that's going to come down a little bit as rates come down, because they won't be able to charge as much. But what I believe is, if we in fact can keep an economy together, and if in fact we could see some growth from the economy, that's going to increase the loan growth. So it's going to increase volume. And at the same time, that's kind of regardless of who won the election. But now that we know who won the election, we know that there's been a lot of talk about deregulation. Which sector is that going to help in a big way? It's going to be the financial sector. So I think this is kind of, you know, unlocking the chains to a degree for the likes of a SoFi. So that doesn't go to say that I own any SoFi. I do options once in a while with the likes of SoFi. So, you know, not up to date on looking at what the valuation is today, but just broadly thinking about this company in the sector that it sits in. Those are just some quick thoughts there. Overall, Philips Healthcare is down a lot. Do you see opportunities in this sector? I think it is opportunities, but it's again a stock pickers. This continues to be a stock pickers market. Doesn't mean you can't go the ETF route, but there's a lot of stocks that are working, and there's a lot of stocks that are just getting hammered. So when you do go that route in a period of time like we've been seeing over the past year plus, things kind of just even out to a degree. So if you're are truly interested in saying, I want to beat the S&P 500, that's my goal every single year, or whatever the case may be, I want to earn X return on an annual basis, it's going to be a little bit more difficult from that standpoint there. So there's going to be certain healthcares that are going to work, and there's going to be certain ones that don't. But we'll have to see how things play out in Washington in terms of who is actually going to be sworn in and leading certain areas of healthcare per se. So McVane's got 200 shares of Realty Income. That's fantastic there. Why is healthcare down big yesterday? So that was kind of on the backs of the RFK taking over the kind of the whole health sector, which is one of the largest sectors within Washington there. So there's a lot of, worries around biotech type companies. He's wanting to pull back potentially on certain vaccines and certain things from there. So it could put a pump the brakes moment is kind of what we're seeing in terms of healthcare. But from a long-term perspective, these are a lot of these things are things that, are very helpful for a lot of the diseases out there. So there's again a very mix and walking that fine line as a company right now on pushing certain vaccines, or there's certain things that take care of cancer, things like, with AbbVie, what we saw, things like schizophrenia, where that drug had failed. Those things are still going to be plenty fine. But you think about a company like Pfizer, who just came off this COVID pandemic where they just blew through revenues. Well, 80-90% of their revenues were coming from the pandemic. That is obviously gone now, and they're starting to try to push some other type of vaccines. Could be a struggle. That's a position I own and one that I'm thinking twice about right now, given the change in leadership moving forward. So it's going to be give and take. It's going to be a case by case basis there overall there. So definitely, Robert, there's one right there. There's a great example of a healthcare company that's down and down big. And when you look at a valuation perspective, and when you're looking, and I know Robert's a long-term investor, you're getting great entry points on fantastic companies that have fantastic products that are helpful in these cases that I'm talking about in terms of taking care of certain things here. So Merck is, if you haven't looked at that valuation there, definitely put that on your watch list, because Merck is extremely low right now. It is trading at prices that were back in 2022 that we saw. So it's given up all of its gains in 23, all of the gains in 24, and it is trading, I want to say now below $100 if I'm not mistaken there. So Polish Silver Stackers buying some Google as well. Johnson & Johnson is another one that does start to look quite intriguing. Just for Lucky bought some SCHD, love it. Bought some Merck, love it. Bought some AbbVie, love it. And bought some AMAT. Nice. It's a good week of some buys on the dip there overall. So awesome. Well, let's keep rolling here on our Saturday edition. Thank you guys for being with me here. So let's take a look at another economic report, which was jobless claims. So the initial jobless claims came in at 217,000. The continuing, which I believe is a lot more important. That's a more important metric because you can get a lot of volatility in the week by week numbers, which is the initial. The continuing is the folks that continue to claim unemployment, can't find a job as quick. And that sits at 1.87 million folks. So both of those numbers are down from last week, but we have continued to see the jobless, the continuing claims increase over the past few months. So you'll get some fluidity here and there, like we saw this come down just a little bit here. But when you look at the numbers and where they've come from, this is a much higher elevated number than we've seen in the past few months. So definitely something to keep an eye on. Continuing jobless claims, people not only losing their jobs, but continuing to be unemployed for an extended period of time. That number sits right now at 1.8 million there. So let's head over to our Fed watch tool to take a look at the current projection in terms of where is the Fed taking interest rates here. So we continue to see this number come down. So this is the probability, the futures in terms of what is the Fed going to do around cutting interest rates. So right now we sit at a target range of 450 to 475. There's a 62% chance that comes down to by 25 basis points. So that's pretty much what's baked in right now, is we are going to get a 25 basis point cut during that December meeting. And that number has steadily come down, because if you look down here at the bottom, a month ago, there was over an 80% chance that we were going to get a 25 basis point cut. Now that we have seen that CPI report uptick, now that we have seen that PPI report uptick, and the economic activity starting to ramp back up a little bit more, there's some concerns around lowering those rates too fast. That's what I've been talking about the whole time here. So there are concerns around what can happen from an economic standpoint. And no longer do we think there's an 85% chance that they're going to cut rates. That is now down to 62. So they're still baking it in. We're still over 50%. So it's still a high 62%. However, that number has come down drastically there. So when we go to the January meeting, that sits at 54% on where that would be the 25 basis points from right now. There is a group out there, 20%, that believes that we will get 50 basis points between now and the January meeting. So let's go over and take a look at probabilities to see where we could end up at the end of next year. So at the end of next year, they are baking in that we will see interest rates around 375 to 400. You can see that's the highest percentage there. About 30% of the futures believe that interest rates will be at 375 pretty much a year from now. So at 375, and when we looked at the current rate right now, I told you we were at 450 to 475. So not as many cuts as we initially thought there. Things are starting to slow down, which is why I believe we're going to get that prolonged. And that question from John is so important that although I love REITs, probably not something we need to be rushing out to right now, because those rates are going to be higher for longer than initially expected by many investors that are out there right now. So that's kind of where things stand right now overall in terms of the economy and what's going on. So obviously defense stocks haven't been performing well. Healthcare stocks have not been performing well of late. And there's a lot of things in the economy to have some concerns about. Now, I mentioned this during that post-election period here, that there's things to be concerned about, but there's also reasons to be optimistic. And we are an optimistic, community as investors. And the other reason, though, is there's data that's behind it. When you look at the start of November through the end of April, that's a 6-month period. And when you compare that to every other 6-month period throughout the year, this is the most bullish for the S&P 500. This tends to have the highest likelihood of stocks gaining. Not only just gaining, but have the biggest move higher gains over that 6-month period there. So from a seasonality perspective, this tends to be the time. We not only see the run up to the end of the year. Now there's a few things to be mindful of. And I talk about this within the Investing Accelerator, the group coaching program, as well as the one-on-one, is there is seasonality from a 6-month period, but there's also some tax loss harvesting that goes on, which typically we do see a dip heading into year end. And then we see the so-called Santa Claus rally, because there's a lot of these hedge funds, big money managers. And even if you're managing your own portfolio, you want to follow suit here in setting up your taxes. You could have gains to where we're not paying taxes, even in taxable accounts, if you manage the portfolio properly. These are things that we are talking about within our 6-week course here. So make sure that you sign up for that course. Again, we have 4 spots left in terms of the Investing Accelerator group coaching program. We'll be talking about many of these strategies throughout it. But most importantly, we're going to teach you how to value stocks. We're going to teach you how to analyze stocks and build a portfolio based on your risk profile and set you up. This is something that you can take this program. It's not coming in and I'm going to say, hey, I'm going to give you 6 stocks to buy, and that's it. That'll help you for the next 6 months or so. But if I show you the roadmap, that's something that can work today, tomorrow, and decades down the road. That's how you build generational wealth right there, folks. No longer do we need the financial advisors where you're paying every single year. If you invest in yourself and learn how to do it right here, whether you want to be a hands-on investor or a hands-off investor, it's a one-time investment. And then you're off to the races and you continue to learn from there. It's going to build that base. It's going to take you places. And every single person that comes out of this program, many of them that I see in the comment section right now, their one thing that they say, I wish I did this sooner. So definitely sign up. We got 4 spots left in terms of that program. There's a link, and I'll drop that link here again where you can find all the information. We have different payment plans if you're interested in spreading it out, making it easier on the wallet from that perspective. But the 4 spots left right here are the ones that that we're giving out the additional $500 discount on right there. So if you're serious about investing in yourself and going to the next level, again, regardless of where you're at as an investor, whether you're just starting, whether you've been investing for a while, whether you have a financial advisor, this group starts on Tuesday. November 19th, 8 p.m. Eastern time. And you don't have to be able to join us live. If you want to take it at your own time and be able to and watch the replays, definitely take this still. You can watch it at your own pace. You can join us live, whichever is best fits for you. And that's why we do the group coaching program. You get access to all the handouts, all the slides, any of the valuation tools and calculators that we go through here. So we got those 4 spots left right there for you guys to take advantage of. So that's the Fed Watch tool. And then right after this at 8 a.m. Eastern time, which is or 11 a.m. Eastern time, 8 p.m. or 8 a.m. Pacific time, if I get my words correct there, I'm doing my Edge Plus members only monthly meeting. So this is an added perk for those of you that are part of my Discord and newsletter. Definitely make sure you stay tuned. We'll be starting here in about a half hour, taking a deeper dive at my portfolio, looking at what I've been buying, looking at what I've been selling, going through those top positions and talking about, is this a stock I'm looking to hold, looking to sell, and kind of analyzing it on a case-by-case basis there. So that's going to be a fun one there, reviewing some of the top stocks I'm looking to buy on my watch list, and we'll go through a full Q&A there. So you can check out the Stock Investors Edge and become a paid member there and get access to my entire portfolio and see what I'm buying on a regular basis. So that is all I got for you today. Thank you guys for joining me for this Stock Market After Hours Saturday edition. I hope you guys enjoyed it. It's been a joy coming into your guys' home, whether it's in the morning or whether it's in the evening. And thank you guys for the support. If you could do me a huge favor and click that like button down below, that would be greatly appreciated. And for those of you that are Edge Plus members, I will see you in the monthly meeting in roughly 30 minutes right here. So we'll see you real soon. Thank you guys again and have a fantastic weekend. Take care.